When you first start out, managing your obligations while paying rent and utilities may seem difficult. With a little trial and error, you'll soon start to master your monthly budgeting. The next natural step after achieving that goal is to start investing, although this can be the most challenging part. We wrote this thorough guide on how to start investing for beginners as a result. If you have trouble getting started, you can also seek assistance with making investments on a limited budget. From the time you decide you want to start investing, you'll likely receive a lot of questions about how much to put into it. Where should I invest my money? For how long? How do I start exactly? When it comes to investing, there typically is no right or wrong choice because the concept is not one size fits all. Your strategy will depend on how much cash, how much time, and how much risk you are willing to accept. In this video, we will discuss 10 steps that can help you start devising a plan. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. Number 1. Learn your investment options. Before you begin investing, you must be aware of the various types of investment options accessible. The list below includes some of the most typical options you might encounter, while it is by no means exhaustive. When you are familiar with the things on the list below, you can start researching more complex investment instruments. Here are 5 well-liked options to help you make a decision before you begin investing. Stocks. You effectively become a shareholder in the company when you buy stock. Depending on the company you buy in, a single piece of stock might cost anything from a few dollars to hundreds of dollars. The firm's success as well as the status of the economy as a whole will affect how much the stock changes. Bonds. Businesses, governments, or municipal governments issue bonds for the benefit of private investors. Bonds are obligations that investors will pay off after a predetermined period of time. Up until that time, or until the bonds expire, investors will get interest. Because of these strict requirements, bonds are seen as being less hazardous. Exchange-traded funds. Exchange-traded funds, or ETFs, are assemblages of individual investments. The fact that ETFs are exchanged continuously sets them apart from mutual funds. Similar to stocks, they are purchased for a share price. If you're just getting started and have a modest spending budget, ETFs can be a smart choice. ETFs are more accessible since their share prices are frequently lower than the minimal investment required for a mutual fund. Real estate. When the word investment is brought up, Wall Street traders are typically the first thing that comes to mind rather than real estate. However, real estate is still one of the most profitable and dependable types of investments. Perhaps you're a youthful investor who steers clear of real estate due to the seeming expense. Many individuals are not aware that you can utilize a loan to leverage a down payment to finance the purchase of a home. The fundamental procedures for starting a real estate investing business have been defined. Alternative investments. Alternative investments are assets that don't fall under the typical categories of investing, such as stocks or bonds. Real estate is one illustration. Through alternative investing, one can access the worlds of venture capital, hedge funds, fine arts, antiquities, etc. High net worth investors commonly hold these items because to the higher levels of risk and asset costs. Number 2. Determine how much to invest. Before you begin investing, deciding how much to put aside is an important consideration. The best way to determine how much money to invest is to work backwards. Establish your desired level of investment success and the time frame required to get there. You need to think about the interest rates on your investments. Then you can go back and convert your total investment amount into a weekly or monthly sum. This step is crucial since it will let you evaluate your budget in greater detail. Knowing just how much additional spending space you need to make in your budget can increase your chances of success. On how to trim the fat from your monthly costs so you can start investing much more quickly, Dave Ramsey offers some great ideas. It's common advice to invest 15% of your salary. This amount appears to give you the most momentum in terms of both time and compound interest. This is particularly valid if you're trying to save money for a large investment like college or to pay off your mortgage. Number 3. Start investing in a 401k. For many people, a common financial goal is to save enough money for retirement. If your workplace offers a retirement plan, usually a 401k, you should participate. Your employer may offer a certain type of plan called a 401k that enables you to begin setting aside money for retirement. You give a portion of your income through regular payroll deductions. This donation was made with pre-tax funds. Your company can also match a portion of your contribution if you're fortunate and achieve a certain minimum. Because this is free money, make sure to achieve that objective. It's recommended by experts to set aside 10 to 15% of your yearly income for retirement savings. Number 4. Open an investment account. If your place of employment does not offer a 401k, you shouldn't be alarmed. Numerous reputable financial institutions provide private retirement savings alternatives. These funds are referred to as IRAs, which stands for Individual Retirement Accounts. By paying taxes on your contributions now with a Roth IRA, you can avoid paying taxes on retirement withdrawals. If you already have a 401k, don't instantly rule out a Roth IRA as a second investment option. Your employer might opt to set your 401k deduction at 7%, for instance. Recall that 15% of your salary, at the most, should be set aside for retirement. You still have 8% accessible for investments as a result. Why not let your money grow without paying taxes? Number 5. Choose your investment strategy. Now that you are aware of some of the most common investment options, it is time to choose your investing plan. What is the aim of your savings? We go back to these questions. How much cash will you need to make that happen? How long do you hope it will take you to reach that goal? Based on your answers to these questions, you'll start to realize how aggressive or conservative you can afford to be. For instance, once you meet your retirement savings target, you'll likely have a few decades to invest your money in long-term stocks and mutual funds. What if, though, you desire to accomplish something in the upcoming years? In this case, you shouldn't put all of your money into long-term investments. It could be better to save money where it will still be available in a high-interest savings account. By speaking with a financial advisor, you can make the greatest investing decisions much more quickly and easily. Number 6. Work with a financial advisor. There isn't even the slightest hint of shame in your game if you want to work with a pro. It's strongly suggested that you begin by doing this instead. Due to the complexity of investing, you're going to have a lot of questions. With the aid of an experienced financial professional, you can reach the finest decisions. It's also a great way to discover new investment opportunities and methods. Once you start making autonomous investments, you'll eventually feel much more competent and confident. Number 7. Start investing early. Getting rich takes a long time. Your money will be invested in stocks and other assets for a longer period of time the more time it has to grow. However, some financial experts suggest prioritizing emergency fund development and debt repayment. When money is being used to pay off debt, you cannot invest it or save for the future. We're all one emergency away from getting broke if we're not prepared. As a result, focusing on these two items should come before investment. With a safety net in place to catch you if you fall, doing this will ensure that you may invest as much of your money as possible. Number 8. Be willing to learn. Although it is challenging to predict the market, one thing is for certain, it will be volatile. Being a competent investor requires a long learning process that should be done gradually. You will occasionally be proven wrong by the market. Recognize that and learn from it. Number 9. Build your investment portfolio. Once you make the decision to begin investing, the following step will be to begin building a portfolio. A portfolio is a grouping of several investments. A stockholder's portfolio may contain a range of stocks. Another investor might hold a mix of equities, ETFs, and mutual funds. There is no right or wrong answer. One investor's portfolio will differ greatly from another's in terms of its makeup. This is true since each person has unique financial goals, time constraints, and risk tolerance. However, you are recommended to locate a balanced mix of different assets, especially at start. By doing this, you reduce your risk. By spreading out your investments, you can avoid putting all of your eggs in one basket. Number 10. Be in it for the long term. The most exciting investment decision might not be to stick with the best long-term plan. But if you stick with it and resist giving in to your feelings or fake friends, your chances of success should rise. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.